So I came across this article titled "The 5 Safe and Cheap Dividend Stocks to Invest in June 2021." And it's a pretty long article. I'll leave a link down below. And, his picks at the end of it are good, but I wouldn't say any of them are like amazing deals right now. So it kind of encouraged me to do some research and make my own list of really safe dividend stocks. But more than that, they're just phenomenal all-around companies. So this is my list. We got Anthem, Realty Income, and Public Service Enterprise Group. PEG, I think I'm going to make a dedicated video on this company because I think it is one of the best dividend stocks to own right now. But right now we're on Simply Safe Dividends, and they give a dividend safety rating. And we can see over here that PEG and Anthem are both the absolute highest rating at 99, very safe. And Realty Income is at 70, which is safe. So none of these companies are at risk of cutting their dividend. In fact, all of them have been increasing their dividend every year for a long time. So Anthem is the first company that I want to cover, and this article is labeled, "Here's why Anthem is a better pick than United Health stock." So just a quick backstory, Anthem is the second largest healthcare insurance provider in the US, right behind United Health Group. And I'm sure you guys all know that United Health Group is just an excellent blue chip dividend growth company. They have a dominant market position. They make a ton of money hand over fist that increases every single year. And Anthem is the second largest, still a great company, but because it's the second largest, it doesn't get nearly the same attention as United Health Group. So if I read some of this article to get a better understanding of Anthem, we can see that between 2017 and 2020, Anthem's revenue grew by about 35%, from $90 billion to $122 billion. Looking at United Health Group, total revenues grew by 28%, from $201 billion in 2017 to $257 billion in 2020. So we can see right there that Anthem actually has higher revenue growth than United Health Group. And it says, although United Health's operating margins compare favorably with Anthem over the recent years, Anthem's revenue growth has comparatively been higher, although both companies are benefiting from increased Medicare enrollments, especially in 2020 due to the COVID pandemic. Anthem stock has been weighed down over investor concerns over rising expenses. Going by consensus estimates, Anthem's total revenue is expected to grow 12% in 2021, better than the 9% expected from United Health Group. So even looking into the future, Anthem is expected to grow faster than United Health Group. And then lastly, it says, now, given Anthem has seen better revenue growth both in long run as well as over the last 12 months, and this trend is expected to continue going forward, we think the difference in price to sales multiple of 0.8 times for Anthem versus 1.5 times for United Health will likely narrow going forward in favor of the less expensive Anthem stock. So at the end of the day, whether or not Anthem is a slightly better deal than United Health Group is kind of marginal, because when you're being compared to a company as amazing as United Health Group, that is just a great space to be, and we can see Anthem is in line with them, if not a slightly better deal right now. The dividend is the lowest on this list at 1.2%, but because this company makes so much money, the payout ratio is less than 18%, and the growth rate of that dividend is in the double digits year after year. All right, the next one I got for you guys is Realty Income Corp, ticker symbol O. I'm sure a lot of you guys know about this company, especially if you're a dividend investor, because this company has a cult-like following because it's designed to be stable and have consistent dividend payouts on a monthly basis. In fact, let's read the profile and kind of see what this company is all about. So it says, Realty Income, the monthly dividend company, which is their slogan, is an S&P 500 company dedicated to providing stockholders with dependable monthly income. The company is structured as a REIT, and its monthly dividends are supported by cash flow from over 6,500 real estate properties owned under a long-term lease agreement with commercial tenants. To date, the company has declared 606 consecutive common stock monthly dividends throughout its 51-year operating history and increased the dividend 109 times since Realty Income's public listing in 1994. So that's quite an impressive resume, and you can see why I'm talking about it. It fits this list of safe dividend companies very well. I found this article by The Motley Fool, and it says, got $2,500? 2 unstoppable dividend stocks to buy. The first one they talk about is Realty Income, and I just wanted to read a little bit of what they say about it. So it says Realty Income pays its dividend on a monthly basis rather than just once per quarter, and it also has an impressive track record of consistently raising that dividend. In fact, the company has boosted its payouts by a whopping 111 times since going public nearly 3 decades ago, and it's in an elite club of stocks known as Dividend Aristocrats. Any dividend investor knows what that list is all about. As if that wasn't enough, Realty Income's dividend yield of 4.2% is roughly double that of the average stock trading on the S&P 500. Realty Income leases to names like Walgreens, Dollar General, FedEx, CVS, Walmart, so on and so on. Its portfolio features clients from a well-diversified mixture of industries ranging from grocery to health and fitness to home improvement. Realty Income has continued to grow its balance sheet and portfolio throughout the pandemic, all while steadily enriching investors with its robust dividend payout. In 2020, the REIT generated 11% revenue growth, and funds from operations grew by a healthy 10% from the prior year. So that just goes to show that in any market condition, even in 2020 when a lot of REITs suffered, Realty Income still generated 11% revenue growth. So as the slogan says, Realty Income is just a great monthly dividend company. Now that leaves us with my favorite pick so far, Public Service Enterprise Group. This is a utility company that's pivoting to becoming a green utility company and a whole lot more, a lot like NextEra Energy, which in itself is a great utility company. But this one doesn't have nearly the same attention and media coverage as NextEra Energy. And because of that, it's kind of a sleeper pick, and it's much cheaper in relative terms. So to give you a better understanding of the full landscape of what this company is doing, I want to read a little bit of this article. It's titled Public Service Enterprise Group, More Renewable, More Income to Come. And it says Public Enterprise Group, PEG, is a company committed to transitioning to renewable energy and to becoming a primarily regulated utility. This should enable it to maintain its lengthy dividend streak that has paid dividends for 114 years. Let me say that again. They've paid dividends to shareholders for 114 years. So this is a very stable company. If I continue, it says, the transition to renewable energy is an unavoidable one for the Newark, New Jersey-based utility group to make. In 2019, renewable sources produced more energy than coal, the first time this has ever happened. And that goes to show that they're not just saying that eventually they want to transition to renewables, they're doing it today. And that's one of the things I like about this. And as I read more, it's going to continue to describe what they're doing. So it says, as the trend towards renewable energy continues to gather pace, renewable sources will eventually edge out coal, and the Public Service Enterprise Group has taken the wise decision to embrace the change rather than be swept away by it. To that end, the firm has embarked on a clean energy future program. It has committed $1 billion to a 3-year energy efficiency scheme, which will benefit residential, commercial, and industrial customers, $707 million to an energy cloud investment, which will facilitate superior grid management, and $166 million to an electric vehicle scheme covering residential smart charging, level 2 mixed-use charging, and public DC fast charging with more spending. So let's just digest that for a second. They're not only making huge investments to renewable clean energy, they're also making massive investments to make the energy grid itself a lot more robust and sustainable, and they're investing in EV charging infrastructure. So that makes them connected to the EV market and kind of a electric vehicle charging play. And that's an amazing spot to be. In addition, in December of 2020, its renewable generation subsidiary, PSEG, acquired a 25% stake in Ocean Wind Project, which may provide up to 1,100 megawatts of clean energy and could be running by late 2024. This, along with other regional wind energy investments and its carbon-free nuclear fleet, are but a few of the ways that Public Service Enterprise Group intends to achieve net zero carbon emissions by 2050. Another way was exhibited more recently when in early June, PSE&G Power retired its Bridgeport Harbor Station Unit 3 power plant, the last of its coal-fired generation unit. So I think this article does a good job painting a picture of what direction this company is going and what actions they're taking right now, today, to achieve those goals. And to me, it seems like management is doing everything right. This is a dominant utility. They're transitioning to clean energy. They're investing heavily into wind energy and being a net zero carbon emissions by 2050. And also they're developing EV charging infrastructure all around New Jersey. So I think this is a great play in the green utility space. And if we look at the revenues down here, they're just generating more and more revenue and net income year after year. If we look at their dividend, right now their dividend yield is 3.45%. Their payout ratio is only 58%, even though they've been paying a dividend for over 110 years. And their dividend growth is very consistent. About 4.5% is how much they grow their dividend every single year, very consistently. So to me, PEG is moving in the right direction. They have a long track record of stability with plans to continue to grow in the future. So I think PEG is a phenomenal utility company, and I think it's potentially a better deal than the much more hyped Next Ever Energy. But that's going to do it for the video. Hope you guys enjoyed. If you did, leave a like, subscribe to the channel, and I'll see you next time.